So enough of the housekeeping. We're going to redirect you to the main stage. We're going to bring back managing editor Andy Serwer and a man who needs no introduction, the influential venture capitalist and company founder Marc Andreessen.
Thank you, Stephanie. Welcome, Marc Andreessen.
Thank you.
How are you doing?
I'm doing great.
Have some water.
I'm going to get me some high-altitude water.
Yeah, we need it. I don't know if that's the oxygenated water or not. I can't even say the word. But anyway, we need it bad. So I just want to let you all know that Marc did some sacrificing to come here. He passed up, this is correct, a premiere?
Actually, that is true.
Premiere of the new Batman movie.
Yeah.
And to be here today, so thank you. Let's give him a hand for that. I mean, it's really very nice. I appreciate that.
So instead, I'm going to dress up like Batman and run around Aspen tonight solving crimes. So if you see...
Wow, so don't commit any crimes
If you see motion in the shadows, you'll know who it is.
Yeah, be careful. Chris Nolan really is kind of a genius, isn't he?
He's fantastic.
I mean, he really is. And I don't know whether this is the last Christian Bale movie or not. It is, okay. So we're not going to talk about Batman today, okay? Why don't we talk about the news? Does everyone know who the new CEO of Yahoo is?
Woo!
Yeah, okay, well, so the new CEO of Yahoo, it's going to be announced. Patty Sellers, Fortune's Patty Sellers, just talked to Marissa Mayer, who is going to be the new CEO of Yahoo. She just talked to, or Patty just talked to Marissa on the phone, and the announcement will be at 4 o'clock Pacific time today, and Marissa will be starting tomorrow. Unfortunately, that means she's not going to be coming to Brainstorm, which is too bad, but she told Patty, quote, "There's lots of work to do." I thought that was a pretty good quote.
It's a good first step.
Yeah, absolutely. So what do you think?
Number one, I'm super happy for Marissa. I think it's fantastic for her to be able to step up and take on a CEO job this big. So it's great for that. It's great for the Valley to have product-centric. I'm a big Ross Levinson fan, and I think he's going to do very well no matter where he goes. But it's a big statement on Yahoo's part to go with a product-centric CEO, technologist. Because if they had wanted to go with a sales-centric or content-centric CEO, Ross was the obvious choice. So I think that they decided to, in fact, they announced in the press release, they say that they intend to make Yahoo a product innovator again.
Really?
So it's a very big sort of commitment on the board's part to pursue a product-centric strategy.
What sort of products could or should Yahoo pursue?
I give Marissa a little bit of time to think about that, maybe. It's a challenge. There have been, on the one hand, there have been very few web turnarounds. There just haven't been very many. I don't know if there've really been any big ones. On the other hand, as I always like to say, it's hard to overestimate how screwed Apple was in 1997, and then to see the huge turnaround under Steve, proves that tech companies can in fact be turned around, and in fact they can in fact be turned around spectacularly, which I think was not actually known before Apple. The problem is, there aren't a lot of Steve Jobs characters running around.
Right.
So it's a big job to do what Marissa's doing, to step into a company like that and to take on a challenge like that.
Right. There's a lot to talk about, Marc. Obviously, software eats the world, and Andreessen Horowitz's strategy, and we're going to get to that. But I wanted to just drill down very quickly to, I think, your newest investment, because it's emblematic of some of the things we'll be talking about, and that is GitHub.
GitHub.
Can you say it like that?
GitHub.
Because it's G-I-T.
G-I-T.
Okay. And I'm not sure how many people know what GitHub is. I didn't until very recently. But Andreessen Horowitz just invested $100 million in this company, which has been rather stealth in San Francisco until now. And so why don't you talk a little bit about what they do, because it's not a straight shot, at least for me, and what you were thinking when you decided to invest.
Yeah, so it's a fascinating company in a lot of different ways. So what it does, it's actually two things in one. It's actually it depends which angle you look at it from. So what it is, we call it software eats software development. So it's an online platform. It's a software as a service company that provides a hosted environment for programmers to develop software. And the heart of it is what's called a source code control system, which is one of the main tools programmers use. And so it tracks all your software and all your updates and lets people work together on software. It's the main software repository online for all the open source software. So all the open source software, a very large amount of the open source software lives in GitHub. And then there's a huge advantage to putting your software into GitHub, because the way people develop software these days is they tend to use a lot of open source software, even in commercial software projects. And so if your software lives in GitHub, then you can automatically include all the open source software and the whole thing. It's the best way to develop software these days. So it's a very, very effective tool for that. It's a new generation product into a business today that's a multi-billion-dollar business. So there's companies like Rational that are driving billions of dollars of revenue for these kinds of things. So that's a big business. That's one side of it. The other side of it is it's a social network for coders. And it's a social network in the sense of you have an account on GitHub like you would on LinkedIn or on Facebook. But it's not just things that you say or things that you post. It's actually your account on GitHub correlates to all the work that you do, all the work that you do as a programmer developing software. And so what happens is programmers are building their reputations on GitHub. And so as a consequence, if you want to hire programmers, increasingly you're going to go to GitHub because that's where the programmers are going to be, and that's where you're going to actually be able to see their work. And so we think it's sort of like, it's almost like a verticalized LinkedIn for coders, but with a tremendous opportunity to basically be the place where coders live. And we think that's a big deal. The other really cool thing about the company is how it got built. It was founded by 4 guys who are actually emblematic of something happening in the Valley right now, which is, they came to the Valley, 3 of the guys came to the Valley in 2000, 2001, right as everything was about to fall apart. They went to work for some truly horrible companies. They had terrible experiences. And so they decided to start their own company several years ago to be the company that they would actually want to work for. And so, number 1, they took no outside capital, completely bootstrapped. Number 2, very unique and special culture that really is just a fantastic place for programmers to work. It's extremely high productivity, huge vision. They have very, very, very big dreams. But they had taken no outside capital, literally 0 outside investor capital. And so we did the $100 million Series A investment, which is certainly a record for us. And then I think might be the record of all time for venture capital.
Right. Fortune's Dan Primack pointed out, sort of related to that last point you made, that A16Z is maybe known for either ponying up a higher valuation or putting more capital in. Is that a kind of a conscious strategy that you guys have?
Yeah, so I'd argue with the first one, which is I don't think we actually go in at very high valuations, especially relative to some of our competitors. Notably, by the way, we didn't do any sort of expensive valuation rounds, which you'd consider to be sort of north of 200 million, between basically July of last year and July of this year. So we've basically been out of the market for all those things for the last 12 months. And there's a variety of reasons for that, but it's just the reputation is a little bit overblown on that front. The big one that we've now done is GitHub. We think we paid a very good price, both for the company and for us. The more interesting thing for me is the size, which is $100 million is a big investment for a private company. The main thing that we think is happening is that many of the best, very special new companies are being built as private companies for a much longer period of time. They're getting to be much larger as private companies and over a longer period of time than used to be the case.
And why is that?
Because it's become so hard and unfriendly to be a public company, right? So basically, it's very easy to be a public company in the 90s. Then the dot-com crash hits. Then Enron and WorldCom hit. Then there's this huge amount of retaliation against public companies in the form of Sarbanes-Oxley and Reg FD and ISS and all these sort of bizarre governance things that have all added up to make it just be incredibly difficult to be public today. And so the logical response has been many of the best new companies don't want to go public. And so and this is a very interesting public policy question. The number of publicly listed companies in the U.S. is down by half over the course of the last 12 years, right? So because every year, right, companies drop out of the public market because companies get sold and they go bankrupt, and you need IPOs to keep replenishing the pool, and that flow has basically stopped. So the number of companies that are public has been cut in half, right? Which means that all of the investors who invest in public companies are now fishing in a much shallower pool, a much shallower pond, and those include all the pension funds, right? All the mutual funds. All the actual investors that actually represent ordinary people now can't invest in a lot of the interesting new things that are happening. They just can't invest in the private companies. And so we're creating this kind of 2-tier investment world where if you're a public market investor, there's very few things for you to invest in. And if you're a private market investor, you can do whatever you want. And in a sense, that's really good for a guy like me because we can finance these companies. It's not preventing the companies from getting financed because we can do it privately. But it is delaying the IPO. It does mean that pension funds and a lot of the public participants don't get to benefit from the early growth of these companies, which historically have been a big driver of returns. And so the public market's basically being protected from itself to the point where it's being choked off. And I think it's unintended consequences. I don't know that that's healthy.
Well, I don't think that's what they had in mind when they passed those laws.
Right, unintended consequences.
Right, yeah, that's interesting. And there's a lot of places to go with that point that you just made. In fact, you are on the boards of several large public companies, but as a director, you can't talk about what goes on with those companies, which is unfortunate because you have a deserved reputation as being one of the most open people in Silicon Valley when it comes to talking about what you do and what your company does. But when it comes to being on the board of these public companies, it becomes selective disclosure, right? And you can't talk about that. Having said that, let me ask you this question, though. Suppose you had a fast-growing, very hot soda pop company, and you were looking to go public, and the company decided to increase the size of the offering and then increase the price a couple times. And the company went public, and they were able to sell at this high valuation, but the stock didn't do terribly well, and it pissed a lot of people off, and there was a lot of Sturm und Drang. Would the fact that the company got all this money into its coffers make that a successful IPO, or would the fact that there's all the Sturm und Drang mitigate that?
I don't know. The soda cans are blue, colored blue. Is that yeah?
I don't want to disparage Ingenuity in any way.
With light lowercase, light lowercase letters.
Yes, no.
Yeah, I mean, unfortunately, this whole topic is so
because because what I'm saying is so obviously
it's a metaphor.
Obviously metaphorical about a certain company. You can't really. I don't mean to be cute. I'm just it's just. I mean, I'd love to know the answer to that question.
I will say. Let me take the general case.
Okay.
There's an embedded issue in IPOs, and this again is part of the hostility that the public market has towards public companies. There's an embedded conundrum in IPOs, which is that if they are priced in a way where there's 100% first-day pop, they get reported as huge successes. Right? And everybody's all happy. Like the press is all happy because the stock has gone up a lot. The early investor, the people who bought in the IPO are happy because they made a lot of money overnight. The downside of that, which I've had with my companies a couple times, the downside of that is the company has left an enormous amount of money on the table.
Right.
And like sometimes that's fine and everybody's happy, but sometimes later on in life you wish you had that money, right? Because what that means is the offering was underpriced relative to the true demand. There are other times, when people price these IPOs much closer to the actual demand, that's in the market, and you try to peg it, so it's more or less right, and you try to get a little bit of a first day pop,
yes.
At least if you can. But then there's this sort of weird conundrum where a lot of people who want to invest in IPOs think that they're doing it because there's going to be
it's a right
100% first day pop. There's a right to basically double your money in the first day.
Right.
And so when those people get disappointed, the question would be like, okay, was that a good thing for those people to get disappointed or a bad thing? And I think it's probably a good thing. Because that's a bad pattern.
I understand that. It'll be very interesting to see, 2 years out when you compare LinkedIn, which did have that pop, versus Groupon and Facebook and Zynga, and because right now one's outperformed the other three.
Yeah, sure.
Right.
Well, I would also say LinkedIn did a very good job setting expectations on its financial performance going into the IPO, and then number two, LinkedIn has knocked it out of the park in terms of results. So the thing you got to give LinkedIn enormous credit for is the performance in their business, and they've just done an extraordinarily good job on that. Which is not to say other people haven't, but LinkedIn's been really good. So stock prices do at the end of the day correlate to how well the business is doing. So.
And then when you talk about consequences, you talk about the consequences of the Facebook IPO are a chilling of the IPO market, right? I mean,
I think I think the IPO market.
I'm just saying.
I think the IPO market was pretty chilled to start with. So I mean, look, it's
if that had been a moonshot, maybe not. But who knows?
We live in unpleasant times, right? So number one, tech stocks. So right now, the public market hates tech stocks, right? So sort of assumption number one, public market hates tech stocks. The reason I say that is because tech stocks are trading at a 30-year low relative to industrials.
And you mean that broadly, the software, broadly, hardware?
The whole sector, the entire tech sector. The public market the public market stocks are trading at rock bottom PEs relative to any other time in history. Like you have to go back to the mid '70s oil crisis, horrible stock market blowout.
Why do you think that is?
We're still living through the hangover of the 2000 crash. So the 2000 crash was a generational psychological event that still weighs very heavily on people's minds for anybody who lived through it. And just when it looked like we were starting to get back up on our feet again, then the financial crisis in 2007, 2008 hit. And now, of course, Europe blowing up, China slowing down, huge amounts of money being pumped into the U.S. without job growth. Everybody's just in a horrible mood by public market investors.
And people, they're talking about high-yielding stocks, which are not tech stocks generally, and they're talking about multinationals, which sometimes are tech stocks.
Yeah, and gold. I mean, everybody wants, it's gold, and it's commodity. In any area you're in and where commodities are the hot investment topic is like a very depressed environment. because it just doesn't make any sense. It's not where any of the growth for the future is. So we're just in one of those times where just everybody hates tech stocks. Now, historically, that's been a very good indicator, right? In terms of, this is the time when you tend to get the headlines, the magazine headlines like depth of equities, right, which are sort of the famous contrary indicators. And I do think we live in that time. It's hard to call it, whether it's this year, next year, or the year after. But the psychology couldn't get much worse. And then to your point on LinkedIn, right? Most of the other tech IPOs in the last 2 years, the stocks,
right.
Forget whatever first day pop they have, they then crash, which again is a sign people are not willing to take any risk on these things. They just want out.
I saw that short sales. I saw that crossing the tape. That were on high since going back to the last September. So that's always the same kind of thing. Yep. Shifting gears completely, what are you and your partner Ben Horowitz most excited about right now? What's the thesis?
Yeah, so the big thing we're excited about is it just feels, I've been working in the industry now for about 20 years, and it feels like, I have a lot of people in the room, it feels like a lot of the work that we put into building, originally before me, but the PC industry and then the internet and now the smartphone industry, it feels like a lot of work got put into getting us to the point where we actually have the internet in everybody's hands. And both on PCs and now increasingly on smartphones. And so it feels to us like now the game is actually beginning of, okay, what are the true internet killer apps? What effect is the internet going to have on a very broad swath of businesses and industries? What are the great internet franchise businesses that are going to get built? And it's funny to be talking about that because this was the big topic of conversation in 1999.
Yeah.
It was just, we were all just early in 99 because it turned out like 1999, right? 50 million people on the internet, 25 million on AOL. It was just early, whereas now, global addressable market is 2 billion people on PCs, on the internet, and pretty soon 5 billion smartphones. And so now, and broadband fully deployed. So now we have the chance to actually build all the businesses that we thought we were going to be able to build in the late 90s. Right, so when everybody was euphoric, it was too early, and now that everybody's depressed, now's the right time, which is sort of, par for the course. But we're excited about it because we're just, the way I put it is, the things that are working, the new businesses that are working really well. I mean, the really astonishing thing, it's, we're in venture capital, so not everything works, but the stuff that works is just on fire. And these, you just go through, through our portfolio, you just go through a whole sequence of things, but, companies that aren't in our portfolio, would include companies Dropbox and Evernote and, Spotify and there's specifically naming ones that we're not invested in that are just on fire and are just Uber, just spectacular companies, and they're growing at light speed. And we actually have this phenomenon now where we have a pattern of companies that can go from 0 to $1 billion in revenue, right, in just in very little time when they really crack the code. And then that goes back to the thesis we have, the investment thesis we have, which is software eats the world, which is basically that because of the world getting connected and because of PCs and smartphones being in everybody's hands, you can now build internet-style businesses or .com style businesses in many industries, and basically sort of the internet and software can colonize other industries. Airbnb is software eats real estate, and Uber is Airbnb eats software eats taxis, and GitHub is software eats software development. And we just funded a company called Solem, which is cloud analysis of soil samples for precision agriculture, which it's an internet company that focuses on soil. So we call it software eats dirt. We're basically just seeing this pattern across a very wide range of businesses, and it's a very exciting time to build these companies.
You talk all the time about software, and you're Mr. Software, but you're also on the board of HP. I know you can't talk about that, but hardware still exists. And Lenovo's here, Michael Dell's here. You're on the board of HP. You've invested in some hardware companies. How does hardware have a role in this going forward? It seems like it does.
Yeah, so I think that the fact that software is becoming so important is actually leading to a new kind of hardware renaissance. I'm actually a little bit radical on this. I think that consumer electronics might be in the process of coming back to the US. And that's a pretty big deal for those of us a little bit older, like Andy and myself. 30 years ago, it was when I was growing up, it was a huge topic of like all the consumer electronics businesses were leaving the U.S. because it was all commoditized manufacturing.
Right.
It's interesting. Today, you've got the iPhone, and it's still assembled in China, but all the components are built and designed in the United States. All the profit flows back to the United States. You've got obviously the entire smartphone industry now. All the software is being built in the U.S. And then you've got all these new categories, and we have 2 investments we're very happy with. One is Jawbone, and the other is this Lytro, which is our new camera company. Both of which are hardware companies. Designing everything in the U.S. All the profits coming to the U.S. And the thing that we think is happening is basically these products are extremely sophisticated software wrapped in very special hardware. But as a consequence, companies that can only do hardware, right, are going to have a very hard time. And so, like, one of the great stories of our time is what's happening at Sony, right? Because a lot of people remember Sony used to be the innovator in consumer electronics,
Right.
And now the new CEO has who's a very talented guy, has a huge challenge on his hands because Sony never became a great software company, right?
Right.
And the disconnect between Sony and Apple is largely a story of software, not hardware. So we think that there's this model for basically extraordinary software wrapped in special hardware that is going to be a very big deal. It's going to apply in more and more categories. And then American companies in many sectors are going to be the leading companies because the American companies tend to be better at software.
And you indicated to me that there's some on your radar screen right now, in fact.
We have another stealth investment, which I'm very excited about.
And the name of that company is, what is it?
I can't name it, but
Okay, I understand.
hopefully we'll be able to announce it. How about next year on stage up here?
Right here. Okay, you have some witnesses.
It'll be something everybody will be very excited to take with them and take home to their kids. Let's put it that way.
I like that.
Very cool new hardware.
Hey, I want to take 1 second out because we have our first AT&T mobile polling question. Cue the music. That was amazing. That was genius. Okay, here's the question. The question is, and it's open to all domestic carriers. What will future generations remember Marc Andreessen for? Is it A, co-founding Netscape? Is it B, Andreessen Horowitz's pledge to donate half of venture capital earnings to philanthropic causes? Or is it C, none of the above, whatever it is, hasn't been invented yet?
How about option D, misspelling my name on the quiz?
That's a real problem. I apologize for that.
It's okay, I'm not allowed to vote.
I've gotten my name misspelled too, but not by your company, so.
Okay, good.
Okay. Anyway, so go ahead and vote. Sorry about that, Mark.
No problem.
So, would anyone like to ask Mr. Andreessen some questions? Now, that's pretty badass. I might have misspelled your name wrong, but I got the guy to hit the thing, okay?
God does not like venture capital.
No. Okay, could you please wait until you have a microphone because this is going out to the universe and we need to hear who you are and hear everything. Yes, we ready? Microphone in place.
Hey, Mark, Dan from Mac Fortune. Mark, I'm curious, you just mentioned you think that the consumer electronics could be coming back to the U.S. You talked about how things are being designed here, still assembled in China. Do you see the assembly potentially coming back? Does it get to the point where for those companies it becomes cost effective to build where you're designing?
Yeah, the assembly, this is the whole thing. This is the whole, to me, this is a lot of the fallacy around China. So manufacturing is a very loaded word, right, as you know. Manufacturing implies that something is getting created. But a lot of what happens in China is assembling components that are built elsewhere, or assembling components that, if they're manufactured in China, they're based on American IP. And so the way you actually, in my view, have to look at it from an economic standpoint is gross margin, right? So what is the actual embedded margin in those products? And you basically follow the profits. When we follow the profits, you find that basically the people who actually design the IP, get the majority of the profits, which is kind of how it should be. And so the assembly part is sort of an arbitrage of labor against transport, right? Which is it's cheap enough to ship everything and then ship it back, and then it's cheaper to actually do the manufacturing. I don't know if on the one hand, if these products get more componentized and they become easier to assemble, then that argues you could bring them back because there's just less work to do during the assembly part. You could also argue that if they get more complex and there's more parts that go into them, you should also bring them back because the manufacturing job gets harder and you might want to have it close to home. You probably want to track the cost of shipping pretty carefully because that has a lot to do with it. But I guess the final thing I'd say is I think it actually doesn't matter that much because as long as everything's, this is where I think the China thing's overblown, as long as everything is being designed in the US, I don't think it really matters where it's built. I don't think that really has anything to do with the economics. It doesn't have a lot to do with any of the high value jobs. And frankly, the other problem is there are very few Americans who would actually want to work in a Chinese manufacturing plant, at those wages.
Question over here.
Michael Schrage with MIT. Mark, you've been a pioneer on the cloud. You really, with GitHub, are very focused on the economics of coding. I'm very interested in your perception of the coevolution of cloud computing and machine learning. Mm-hmm. How steep is the machine learning curve?
Right.
And how big of an opportunity is that for redefining the kind of services and speed and agility associated with those services for the internet revolution you're describing here?
Yep. Yeah. So machine learning might be one of the few areas my friend Peter Thiel and I might agree on, which is I love talking to Peter. I love arguing with Peter. Because he always comes up with new ideas. I almost always disagree with him, and then he's almost always right. So I don't know what the pattern there is, but so he's taken the position that now is exactly the time to go long on artificial intelligence, as he puts it. So, those of us who have been in the computer industry for a while, AI is sort of a malign term. Machine learning is the new term for AI because AI became such a term of bad repute. People lost so much money on AI. It's like when everybody lost money on pen computing, then all of a sudden it became tablets. Or after we lost all the money in the dot-com era, then we started building cloud companies. So now we might be entering the golden age of machine learning or AI, and the reason actually has a lot to do with the cloud, which basically is, it turns out the approaches to AI that work are not the ones where we try to get a computer to think like a person. They're the ones where we basically use essentially extremely sophisticated brute force algorithms against extremely large amounts of data. And the most interesting example of that is using Google as a spell checker. Google is by far the most impressive spell checker ever built. Spell checking is sort of a classic AI problem of understanding a language and then being able to correct syntax and grammar and spelling. It's always been hard to get spell checkers to work right because it's been hard to train computers how to speak English or how to translate languages. Google is the spell checker that works in virtually all cases. And what's interesting is Google doesn't actually have a spell checking function. Right? It just simply sees all the different queries, and it sees where people end up correcting themselves in volume. And so it's able to automatically predict that if you made this mistake, therefore you would end up doing this other thing. And so it's this amazing spell checker. And that same kind of approach is now being used in a lot of other areas, predictive analytics and face recognition and all kinds of things. And the whole basis of it is huge amounts of data. And so the cloud aspect of having huge amounts of data in the cloud will basically power a lot of those applications. And now is probably a pretty good time for that.
The question over here.
Mm-hmm. Hi, Mark and Rick from Google. Good to see you again. In the 80s, we saw single-point solutions like Harvard Graphics on the computer, on the PC software, Harvard Graphics, WordStar, and Lotus 123. And over time, those consolidated into a suite that became the Microsoft suite. Then we saw that again in the computer software, on enterprise software, on a single point for accounting, manufacturing, supply chain, HR, and then SAP and Oracle again try to consolidate and becoming an integration. And now we are in the phase on the internet that's facing the same problem, which is a lot of single point solutions. And what do you see is going forward? Are you going to see this as converging to an integrated solution with suites coming up and aggregators of that? Or you think the integration cost is going to be low, so we're going to continue to see a single point of solutions for a while before they integrate? Yeah. If they ever integrate.
Sure. And you're talking more about cloud applications, business applications?
Well, I could be business and B2B and B2C, okay, because the user has the same problem, right? And this trend of consumerism between B2B and B2C would probably aggregate to both.
Yeah. So in the long run, there will probably be consolidation. I think it's still really early. There are some companies that are being able to expand their footprint. On the business side, Salesforce.com and Workday would probably be two that would immediately jump to mind. That'll probably add more functions over time. But I think it's still really early for cloud applications in general. On the business side, I think we're still, so a couple things. One is we're still figuring out what the killer cloud applications can be, and there's lots of new ideas being experimented with. Number two, cloud companies are able to go after much larger markets than historical enterprise software have been able to go after, right? So the market for Salesforce.com is a lot bigger than the market for Oracle because Salesforce.com can go down market much more effectively. They just can go after a much larger number of businesses. We don't yet have a real sense, I think, of what all the different categories are in the new world and then what the market sizes are and how big the companies can get. So I think it's going to be years before there's sort of a big consolidation. That's like 10 years out or 15 years out. Integration also is actually pretty easy on the cloud, and there's a bunch of companies that specialize in that. We've got a couple of them in our portfolio that are really good.
One more quick question back here.
Hey, Mark. Chris Fralick from First Round Capital. Can you talk about how venture capital is evolving to help startups beyond just writing a check, and in particular what Andreessen Horowitz is doing on that front?
Yeah, that's the...
Yep. Mm-hmm. So I might take slightly longer than 30 seconds to answer that question. there's a whole. So one of the fun things about venture capital right now is there are a bunch of new models, and so there's what you guys are doing as one new model. What YC is doing is another new model. There's a whole bunch of them, and I think it's, as an entrepreneur, I'm excited because I think it's a good thing to experiment with. If you're going to be in the business of funding innovation, actually doing some innovation might actually be a good thing. So it's a very exciting time. Our approach to it, is sort of based on our backgrounds, our experience. It may or may not be right, but we think it works. Which basically says, basically at its heart was we had great experiences with the VCs we worked with, but we were always wishing that they would do more for us in certain categories. And so we basically said, as a firm, let's build up the capability to do those things in those categories. Not do the things where they would have just interfered with us, but the things where they could really, really help us. The big thing turned out to be network. We always wanted more connections. So we always wanted more customer introductions. We always wanted more business development relationships. We always wanted more international help. We always wanted more talent. We wanted more referrals of help hiring programmers, executives. We wanted help working with the media. All these things where you would, later on investors, acquirers, all these things where you would think venture capitalists have relationships that have been built over 10, 20, 30, 40 years that you could kind of plug into as the next startup. And what we found is venture capital firms in general just have not systematized the network. And so the big thing that we're trying to do is we're trying to systematize the network. So we're doing it across categories. We're doing it for customers. We're doing it for partners. We're doing it for acquirers. We're doing it for future financing rounds. We're doing it for press. We're doing it for talent. And we have dedicated teams in each of those areas. And so when you work with us, you get a GP, and then you also kind of plug into the network. And it's at this point becoming a very large network. We're going to run 600 corporate briefings in our office in the next 12 months. And so our entrepreneurs literally get an agenda that basically says, if you want to meet with the CEO of GE, it's next Tuesday at 4 o'clock. And it's like that every week. And that turns out to be good for the big companies, and it also turns out to be good for the startups.
Great. All right. We are out of time. We're going to have to leave it at that. Please join me in thanking Marc Andreessen.
Great. Thanks, everybody.
Thank you.
Thank you, sir.
Thank you. Oh, and by the way, the winner of the quiz, the answer was A, co-founding Netscape. Adam Lashinsky.
Thank you, boss. Thank you, Mark and Andy.